Imagine for a moment a small village nestled in the hills of Nepal. A message arrives, money sent from thousands of miles away. From New York City, a bustling, iconic city of America, to a lady working in a millet field with 3 children playing nearby. These everyday transfers add up to a vast, often unseen global force. Millions of transactions every day. They pay for school fees, medicine, and a safer future. In 2023, recorded remittances to low- and middle-income countries reached roughly $669 billion, more than many official flows. For families, this money is a lifeline. Behind every transfer is someone working and sacrificing far from home. This is the story we'll follow, one transfer at a time. First, what exactly are remittances? Remittances are the wages that migrants send home to support family and household needs. They are personal transfers, not foreign aid or corporate investment. From factory workers to construction sites and health and office jobs abroad. Individually small, together enormous, a collective river of funds. Remittances have proven unusually resilient in crises. In 2023, recorded remittances to LMICs were about $669 billion. Global average transfer costs remain above 6%. SDGs target 3%. Money can flow through formal channels, banks and licensed operators, or informal networks like Hawala. Informal systems are often faster and cheaper, but riskier. Receipts can be cash or mobile credit. The form varies, but the impact is direct. For many families, it's immediate relief and planning capital. Personal paychecks become a powerful economic force. Next, how that money fuels health, education, and dreams. Remittances often pay for clinic visits, medicines, and vaccinations. Studies link remittance inflows to lower infant mortality and better life expectancy. Families afford more nutritious food, critical for children's development. They also invest in sanitation and clean water. School fees, uniforms, and transport. Remittances remove barriers to education. Enrollment rises, especially for girls. An educated child is likelier to earn more, changing generational prospects. Household studies show remittances contributed to sizable poverty reductions in several countries. Remittances seed small businesses, a sewing machine, livestock, or a shop, or durable assets like concrete roofs and improved housing. In farming communities, remittances finance irrigation, seeds, and small tractors. Those investments raise yields and food security. The data backs up these stories. Remittances increase spending on health and education, graduates, healthier elders, and new entrepreneurs. Real impacts on real lives. Remittances not only help households but boost local markets and jobs. But there's another side: empowerment and dependence. When men migrate, women often become household heads, managing money and decisions. This can shift gender roles and increase women's agency. Spending supports local jobs, builders, artisans, and vendors. Over time, this can help narrow income gaps, if used productively. But over-reliance can create vulnerability to host country shocks. Remittances can reduce local labor supply in some areas. Remittance households may access better housing and services, creating local divides. And the human cost: long separations and emotional strain. The challenge is maximizing benefits while managing trade-offs. Smart policy can tilt outcomes toward long-term gains. That brings us to payments, formal versus informal channels, and the shift to digital. Digital options are changing the game, lowering costs and increasing security. Senders choose formal banks and apps or informal brokers. Formal channels are traceable and offer recourse if something goes wrong. Hawala moves value via trusted brokers. No cross-border cash movement, fast and informal. But it carries fraud and security risks with no legal recourse. Digital apps make transfers faster, cheaper, and more secure. Competition and fintech innovation are driving fees down, returning more to families. When remittances enter formal systems, they become visible in national accounts. They strengthen foreign currency reserves and stabilize exchange rates. Deposits into accounts open access to loans, insurance, and savings tools. Transactions become traceable and insured, protecting senders and receivers. The mission: expand digital access and lower costs so more families benefit. Next, practical policies that maximize remittance benefits. Cutting fees from over 6% toward the 3% SDG target puts more money in families' hands. Transparency and competition are key. Financial education helps recipients budget, save, and invest remittances productively. Designing simple banking products removes barriers in rural areas. Diaspora funds and investment instruments can channel savings into business and infrastructure. Mexico's Tres por Uno model multiplies migrants' contributions via matching grants. Diaspora bonds and tax incentives can attract longer-term investment, though design matters. Using future remittances as collateral can improve credit access, but it has drawbacks. Risks include exposure to income shocks if migrants lose work, costly loans, and reduced household resilience. Successful models: Mexico's Tres por Uno, targeted diaspora funds, and matched community projects that build schools and clinics. Returned migrants often bring skills and capital that seed local entrepreneurship. Digital literacy programs teach recipients how to use apps, compare fees, and avoid scams. Simple training increases uptake of safe digital channels and maximizes benefit. A combined approach: lower costs, digital access, financial education, and investment incentives, delivers better outcomes. When guided well, remittances nourish families and nations alike. Policies and digital tools can turn private transfers into public progress. Learn more, share this story, and support safe, low-cost remittances.